Personal finance practice problem using OneNote. Purchase on credit versus cash decision. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 6120 Purchase on Credit versus Cash Decision tab. Also note when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. Our scenario is that we're thinking about purchasing something. It might be an appliance, washer, dryer, or something like that, dishwasher, cash price, $3,100. Decision, do we want to be paying cash for it or do we want to be financing it, and how much would it be costing, or what would be the difference between the two? We're going to say that there's a down payment of the $620 if we were to finance it, and we have the monthly payments of $140 as the option provided us for the financing of it over a 2-year period, or in other words 24 months standard installment type of agreement. So in that situation, first thing we could consider, we could say, well, there's 2 years that we're paying off. Obviously, the first thing I could do is try to think about what's the total amount that we're paying if we were to be financing it versus the cash price if we were just to put down right at this point the $3,100. And then if we wanted to extend that further, we can think about this using time value of money calculations as well. So the first thing we would probably do is say, all right, well, how much would I actually be paying over the 2-year time period? Now, that's not too long, not too far out, and therefore the time value of money is not going to have as much of an impact as it might have if it was 5, 10, or 30 years out, as it could be for like a home or larger type of purchases than that. So we could say, let's just do the straightforward calculation without time value of money. Down payment, $650. Monthly payments that they're asking us to pay, $140. Taking that monthly payment times 24, 2 years. Monthly, 2 years times 12, 24. Or 12 times 2, 24. Gives us the $3,360 on the monthly payments, total monthly payments, which would include interest and principal on basically the financing, the loan. So we got the $620 plus the $3,600. That's going to give us the total cost here of the $3,980. So in other words, if I took the 140 plus the times, we need a times there. 140 times 24, we got $3,360 over the 2 years plus the down payment of the $620 we're putting down. That's going to give us the $3,980. Comparing that then to the price, the sticker price, minus the $3,100 if we were to throw down the cash at this point right now. We don't have to throw it down. Like if we had the cash, we could set it there. There's no need to throw it down or anything. We could place it on the table nicely. Or in any case, we got the $3,980 minus the $3,100. That's going to be the $880, the cost of the credit, not taking into consideration time value of money. Now, that's going to be a good comparison, so we could say that's a good number. We might also want to say, well, how much are you charging us with regards to the financing, not just in terms of dollar amounts over the 2 years, but in terms of interest amount. So possibly we can compare the financing charges here to other types of financing, possibly if we wanted to look into getting better financing someplace else in order to get the cash to pay off the $3,100 full amount. So we could then say, okay, well, we know the amount that's being financed is going to be the $3,100 minus the down payment we're putting down at the $620. We are then financing $2,480 of it. What's the rate that they are then charging us? We know that we have the monthly rate we can calculate, because notice what they gave us here. And sometimes you might see a loan given in this way, and they're basically not telling you the rate, right? They're telling you everything except the rate. They're telling us that we're having to pay $140 for 24 months, 24 periods to finance the $2,480, the amount that we're not paying with the down payment. So then we can use our trusty rate calculation to pick up what the actual rate is, and then we can plug that into our amortization table if we so choose. So our rate calculation, and notice this is the monthly rate, so we're going to have to multiply this times 12 to get to the yearly rate. And this is a time value of money calculation. So if you want to look at the time value of money calculation section where we focus in on that just in more detail, you could take a look at that. We're going to use those tools now as they are applicable going forward, which they commonly are when we have things that are impacting multiple periods. So we have equals the rate. We got the number of periods. That's going to be 24. The periods are in months here, comma. Then the payment needs to be a negative. The payment that we're going to have is the 140 for the 24 time periods, comma. Then the present value. The present value is the amount that was financed, the 2,480 in this case. That giving us a result of the 2.59. That is the monthly rate. Monthly rate, not generally the rate that we look at, because usually, even though we're paying monthly, they give us the yearly rate. So if we were to compare that to other loans that were installment type of loans, then we'd have to take that monthly rate and multiply it times 12. That would be the 0.0259 times 12 would be, if we move the decimal 2 places over, 31.08 about, 04 about. There's rounding involved because this number is actually rounded in Excel. So there we have the amount of, in terms of percent, that we can take a look at that's being financed in essence over the 2-year time period, as well as the standard dollar amount. If we wanted to plug that into an amortization table just to see how the financing is functioning, we'd have the amount financed at the 2,480. Calculating the monthly periods at 24, we're going to be saying the 2,480 times the rate, just to double check the rate, which was times 0.3104 about. That would be for a year. Dividing that by 12 would give us the monthly amount of interest, 64 on the first payment about. Then we got the 140 minus the 64. That gives us the loan decrease of the 76. That means the loan balance goes down, 2,480 minus 76 to 2,404. We then take that 2,404 times the 0.3104. I'm taking that yearly rate. We could multiply it just directly times the monthly, but I'll take it times the yearly rate. Gives us the yearly interest divided by 12. Monthly interest, 60, this time 62 about. Then we could take that 140 minus 62 about, gives us 78 about. We could take the 2,404 minus the 78 about, gives us about the 2,326. If we did this for 24 periods for 2 years, monthly payments, we get down to the end result of 0, paying off the entire loan. You can see the spread or difference between the interest in this column and the principal. Even though the payments are the same, we have the totals coming out to the total payments of 3,360 versus the payments total payments 3,360, the 880 interest, and the 2,400 that was the principal being paid back. So the total amount of the payments 3,360, interest 880, the amount that of the loan that was paid back 2,480, and of course that 880 cost is what we also calculated up top when we did this first calculation. So with these kind of loans, if it's a short-term financing over a couple years or something like that, you might be okay with just doing this type of calculation to see what the financing charges are just in terms of total dollar amounts. But it's useful also to kind of think about what the interest rate they're charging you on is if it's a significant dollar amount, and then consider your options for financing that amount and see if you want to take a look at other types of options or use your negotiation point at that point in time possibly to get better terms.